We're now continuing on with part 2 of the IFRS 15 lecture. So in part 1 we introduced the whole new standard IFRS 15. We discussed what it replaced, IAS 18, and we looked at the 5 steps that it's the new framework IFRS 15 is giving. So where we're looking at now is we're going through some of the complexities, and where we stopped in part 1 was we're looking at variable consideration. And we said where you have variable consideration, you have to try and estimate what you think that consideration will be. So what we're moving on to now is we're looking at one particular scenario where you have variable consideration is sale of products with a right of return, which is not unusual in many retail scenarios where you sell goods to a customer but they have a right of return for maybe 2-3 months, and then technically that consideration that you got has to be refunded back. So that would be variable consideration, right? Based on the customer's right to return the products at a point in time. So we have to figure out then, estimate what is our expectation of how much the goods will return. Because those goods that we estimate are going to be returned, you cannot recognize consideration for those, right? So that's what you're trying to look at. It doesn't have to be contractual right. If you give them an implicit right because of your normal business practice, well then you're going to recognize this issue as well. So to do this, IFRS 15 says you make an uncertain number of sales, because when you make sales with a right of return, you don't know how many is going to come back. So you have to estimate it, which is your variable consideration. You recognize revenue for the portion of products you don't expect to be returned, and you recognize then a refund liability for the portion that you do. So there's 2 elements to it. And then for any of those products that you haven't recognized the sale, well, technically you can't recognize the purchase either through cost of sales. So you're going to recognize this asset of a right to recover asset. So it's quite tricky when we get into it. We'll look at a small example to see, but it's a bit more nuanced now than just saying I sold 100 units, recognize the revenue and cost of sales for 100 units. If you expect 4 or 5 of those units to be returned, you can't recognize the revenue for those. That's under IFRS 15. This is variable consideration. So let's look at a small example, might make it a bit easier. So company X sells 100 laptops for 1,000 each. Laptop costs 600 each, so they just resell it on. Terms of sale include a right to return for 30 days. And the retailer estimates that 3 laptops will be returned based on historic sales patterns. So how do you recognize the revenue and expected returns? Well, in this case, this is variable consideration. Because under IFRS 15, you're saying, well, we don't exactly know how many laptops we've actually sold. Because it could be the case that some of those laptops will be returned, and we're saying our best estimate is 3 of those laptops will be returned. So in terms of debits and credits for this, it will be debit bank, the full amount received, which is 100 times 1,000. You're going to credit revenue, this is important, you credit revenue 97 times 1,000, and you credit refund liability 3,000. So what we're showing there is under IFRS 15, you only recognize revenue for your best estimate of how many sales you're going to make. Your best estimate is 97% or 97 out of 100 of those sales are not going to be returned. So they're genuine sales where you'll recognize your revenue. For the 3 that you don't expect to last, that you're going to be returned, what you will do with them is you'll say that money was actually only going to have to be refunded back. So you don't recognize it as revenue. You have a refund liability, which would sit in current liabilities. You then you credit inventory, just to show this side, and you take out the all the laptops, which is 100 laptops times 600, should I say, 60,000. You will debit cost of sales 97 times 600. So you're saying you're matching the revenue from 97 laptops with the cost from 97 laptops. And then this is a new one, debit right to recover asset. And that will be a current asset. And that is going to be 3 times 600, which is 1,800. So the key point is there, if you don't recognize it as revenue, you can't put it in as cost of sales. So what you're saying is there's 3 of those laptops that actually aren't technically sold, and we have the right to recover those if the customer comes back and looks for a refund. So that's why it's called a right to recover asset, because it's actually physically not in inventory, but you have the right to recover that off the customer if they look for a refund and they have a right to return. So it's a bit tricky there. There's two components, dealing with the revenue side and then dealing with the inventory and the cost of sales side as well. So make sure you look at that, and we'll cover that again in tutorial question, and then also be 1 or 2 questions in your pack. The key concept there is there's an uncertain amount of revenue because there's going to be customers coming back with a right of return. So therefore you have to give your best estimate of what the revenue will be. And that's called variable consideration. All right. So once you've dealt in with step 3, what is your consideration? You then have to allocate that transaction price to performance obligations. So you're saying if you have 2 or 3 distinct promises, like we talked about with the handset and the mobile phone contract, or with the laptop and the associated maintenance contract, you then have to have some approach to allocate it out. And the usual one we look at in AF2 is you use their standalone prices. Well, how much could you buy the handset for as a standalone product? How much could you buy the SIM-only plan for the 12-month contract as a standalone price? And then you look at their relative size in the overall bundle deal. There are other alternative ways if you don't have standalone prices, but for AF2 and AC220, we'll just be considered about standalone prices. So take a practical example then of what a bundle discount. So this is like the mobile phone bundle or a laptop bundle deal. In this case, at the year end, 31st December year 2, an entity sells a product bundled with a 2-year service warranty. Right, there's 2 things going on there. So that is 2 promises. One is the product, one is the service warranty. Or in the case of the language of IFRS15, there are 2 performance obligations. And you're selling that for a bundle price of 9,000. The separate selling price for the product alone is 8 and the service warranty is 3. So what we're saying here is that's where the discount is. Bought them separately, it'll be 11, 8 plus 3. Buy them together, it's 9. But what we need to figure out is how much are we going to allocate revenue towards the product, because that's one performance obligation. How much are you going to allocate towards the service warranty, because that's a 2-year and that's a separate performance obligation. So how you do this, the first thing we look at the date of transaction when we sold the product at the 31st December. So if we come down here at the 31st December, year 2, you made a sale for 9,000. Right? But in that was the product and then the service warranty. We'll come back to warranties a bit later. So we need to figure out what portion of that 9,000 is allocated to the product, because this is the step we're on, allocating out. What portion of the product or the bundle is allocated to the service warranty. And you do that by looking at the standalone prices. So the standalone prices here would have come to 11,000. That would have meant 8 over 11, or in this case in percentages, about 73% is attributable to the product, and then the remaining, which should be 27%, is attributable to the service warranty. Now that is important because each of those performance obligations, the product and the service warranty, are accounted for differently because there's different rules about when you recognize them. So how you do that then is you say, well, that's the portion we're going to allocate and that's the overall price. So you say the product is going to get 73% of the bundle price, which is 6,500, and the service warranty is going to get the other portion. So you're still allocating the 9 out, 6,2, and let's bring that down to make it a bit clearer. You're still allocating these out, it's still going to get you 9. So what you're doing there is there's a, as the slide suggests, there's a discount for the bundle. How you allocate that discount out is you get the proportion of each based on the standalone price and you prorata that down to the bundle price. So what that means is when you recognize revenue for the product, which could be the mobile phone, you're going to recognize 6,500. When you recognize revenue for the service warranty, you're going to recognize 2,400. That's your first portion is allocated out. And at the year end when the sale is recognized, this is going to be the debit and credit. You debit bank 9 because the sale was made at that date. You credit revenue for the product, 6545. You only recognize the revenue for the product because that's the sale of a good at a point in time. Once you hand over the product, that's actually the sale has been recognized because you've earned the revenue. Whereas for the service warranty, that's time dependent. That service warranty is a 2-year service warranty from essentially January year 3 to December year 4. And you only recognize that over time. Remember that step 5 is the recognition. So for now, you're going to credit deferred revenue. And that's to do with the 2455. The reason it's all deferred, and that will be split between current liabilities and non-current liabilities. So that's actually in the liability section of the statement of financial position. That's going to be recognized next year and the year after as you earn the service warranty income as the time passes. So at the 31st of December, year 3, you will have debit deferred income in the SOFP, and you will credit revenue. And you'll essentially do half of it because it's a 2-year divided by 2, and the same here. So what that means is the first year of the service warranty is year 3, which is Y3. So that means you recognize a half of the portion of revenue allocated to it. And then in year 4, you would recognize the other portion. So that concept of if you get paid before you earn it, you're going to have deferred income in your statement of financial position. And a good example of that, if you go and you look at, for example, Ryanair's financial statements, which I'll pull up in a second, you will see unearned income. That unearned income is related to flights that have been paid for but haven't yet been flown. So Ryanair have the money, but they haven't provided the service yet. And you can only recognize the revenue once the service is provided. So if we look at that, we'll just get it quite quickly here. So we look at Ryanair annual report, and we look at it for 2019. So you can come here. Let's look at the financial statements initially. Financial information, consolidated financial statements, page 145. Just to illustrate practical terms how this is important for certain industries. And particularly what we're looking at here in their balance sheet is we're looking at current liabilities and non-current liabilities, particularly current liabilities here. Accrued expense and other liabilities, note 10. So 2.99 million, or 2.99 billion, should I say. So let's go on then to note 10. A bit too far there. So this is readily available online. I just Googled it there to show you. So the 2.99 million in note 10. Bear with me, here we are. 2.99 million, of that 1.9 billion unearned revenue. So what that is, it's money that customers have paid to book flights, but the flight hasn't gone yet. Same thing you'd have with a hotel. If you get paid before you offer the service, you cannot recognize the revenue up front. You have to wait until you earn the revenue. Ryanair earn the revenue when the flight goes. A hotel company will earn the revenue when the person stays in the hotel. And in this example we're looking at, the entity earns the service warranty revenue when the period is over, the 2 years, and we recognize it half in year 1 and half in year 2. So it's a bit more complex when you get to the real world, but the Ryanair example there is a good one. Sorry, CRH, we'll come to that in a second. Of some businesses, likes of airlines, hotels, they'll get money up front and then they'll provide the service later. Whereas, for example, supermarkets, they get the money as they earn it. Once the sale is made in the supermarket till, it's recognized in its financial statements because it's earned. So certain businesses are different than others, but the Ryanair one and the airlines are a good example of that concept called unearned revenue. So it sits in the liability section because technically it's money that's owed to customers unless they provide the service. And when they provide the service, i.e. they schedule the flight and it happens, then it goes from a credit in the statement of financial position to a credit in the P&L, i.e. it's your revenue. Okay, so that's an important concept. So then your recognition of revenue, which is our last step, it can either be at a point in time, which is what we had here typically for the sale of products. Once you sell a laptop or sell a mobile phone handset, you recognize the revenue at that date when you give the product to the customer. but you can also have recognized revenue over time. And that's the likes of providing a service where you're providing, for example, an annual maintenance service or an annual mobile phone contract. You recognize it then as the time passes. So it just depends the type of contract that you have and the type of arrangement. And that will dictate how you recognize it. And that is why we have to split the product and the warranty here, because they have two different bases of recognition when you get to step 5. So typically you measure progress if you are going to recognize it over time, either on the output basis, when you look at the performance completed, for example, if a cleaning contract, the number of rooms cleaned or the results achieved, or you might recognize it on an input basis. So you'll recognize revenue based on the amount of inputs in the contract, the number of labor hours, the number of costs incurred. And that will just depend on what the agreement is between the company and the customer. So you just keep an eye out on the question, what exact guidance you're given. All right. So again, when the performance obligation is not satisfied over time, it'll be at a point in time. So when it's a point in time, you have to figure out, well, what point in time is it? And it usually is when the customer takes legal title and when the entity has transferred the physical possession and the risks and reward of ownership over to the customer. So that's the simple example of that would be when you sell products at a supermarket till, then the physical ownership, the risks and reward of ownership in terms of, well, if you damage it after that or you lose it after that, it's nothing to do with the supermarket. So the legal title has passed to that date, and that's when you recognize the revenue. So it is kind of different depending on the type of setup, whether you have a cleaning service or whether you're selling a laptop, whether you're selling a mobile phone, or whether you're selling a mobile phone contract plan. So that's why IFRS 15 came in. It's a lot more nuanced, depending on the more complex business arrangements you can have now in modern business. So that is look at the main 5 steps in IFRS 15, going from identifying the contract, understanding the performance obligations, determining the transaction price, allocating that transaction price to the performance obligations, and finally then recognizing the revenue either over time or at a point in time. Now we just have 2 small other considerations to cover at the end of IFRS 15, 2 practical considerations that you might come across in business. First is warranties, and the second thing is this thing called consignment agreements. So a warranty most people understand is the whole idea of you're getting kind of a guarantee with the product that it fits or it's fit for purpose and as described for a certain period of time. But importantly here, IFRS 15 draws a distinction between a normal warranty that typically just comes with a product anyway, that's not purchased separately, or an extended warranty, a kind of special warranty that can be purchased separately. And they call these a service type warranty and an assurance type warranty. And the importance that they distinguish between these are, they're 2 distinct accounting treatments. A service warranty, these are provided in addition to assurance. So they're kind of an extended warranty over and above the standard warranty that might come with a product. And they, importantly for IFRS 15 purposes, they are distinct service and a separate performance obligation. So that means it's a separate promise, and that means you also have to allocate a portion of the transaction price and recognize it over the service period. Much the same what we've done in this example before, you would say the product and the service warranty were distinct performance obligations, and you have to look at what portion of the overall price do you allocate to each one. Same concept here for a service type warranty. Whereas an assurance type warranty, that's just a promise that the customer that deliver products are specified as the contract. It's not an additional good or service. So it's not a separate performance obligation. And typically how that is accounted for is under IAS 37. That you say, we know we're going to have a certain amount of warranty claims in a year. So it's a present obligation from a past event. And you try and get your best estimate and account for that as a provision under IAS 37. So that's why it's important to be able to distinguish between a service warranty, which is accounted for under IFRS 15 and a bit more complex, and an assurance type warranty, which is really separate to IFRS 15. It's accounted for as a provision under IAS 37. Right. So it just gives you some idea whether it is an assurance or a service type warranty. So is it required by law? The length of the coverage period. So if it's required by law, it indicates that it's not a service type, it's more of an assurance type, because it's required, mandatory. The longer the coverage period, the more likely it's a service type warranty, which is adding extra value to the customer, and the nature of the tasks that the entity promised to perform. So if an entity, for example, only promises certain tasks to ensure the product conforms to specification, it's not likely this is a service type agreement. It's really just a standard assurance type warranty. So you're trying to look at, does this warranty give over and above the assurance that would be required of a standard warranty? Right? So is it giving extra long? Does it go over and above the requirements, for example, for consumer law? And for you, you don't really need to concern yourself too much. It should be fairly clear from the question whether it's a service or an assurance type warranty. But you need to be able to understand the calculations and the debits and credits. This just kind of gives you a small visual. Does the customer have an option to purchase the warranty separately? If it does, it's a service type warranty. Does the warranty or part of the warranty provide the customer with a service in addition to the insurance that the product complies with the agreed upon specifications? So it's a bit wordy, but essentially saying is, does this warranty give the customer more than just saying this product is as specified? Does it give a longer type warranty? Does it give extra kind of assurances or over and above what you would normally expect based on consumer law? And if it doesn't, then it's a normal assurance type warranty. But if it does, then you're into IFRS15 and separate performance obligation. So it's probably best illustrated by a small example. So you have an entity that sells a product for a 2-year extended warranty. Right? Standalone selling price of the product is 2.5. 2-year extended warranty is 500. So actually here there's no bundle discount. The two standalone prices added together comes to the bundle price. But the point is we have the relative proportion of each one that's there. The product automatically comes with a 1-year warranty guaranteeing against any product defects. Right? So for the first year, sales of the bundle were 150,000. And at the year end, all of the sales still fall into the 1-year assurance period. So what essentially is happening here is the first year is the normal assurance warranty because it automatically comes with it. Then the next 2 years, year 2 and 3, these will be the service warranty. So this service warranty here is a separate performance obligation that we're going to have to account for. And you're told then the entity estimates that 10% of total sales will be returned for some level of repair within the first year warranty, and the expected cost per unit of each repair is 400. So we have to try and figure out then, well, how do we separate the service warranty, the extended 2-year, and the automatic warranty, which is the assurance one, that doesn't really offer any additional service. It's really just part of the overall product. And how you do that is, in year 1, the assurance warranty is for the first year, and you're told 10% of units our total sales are expected to be returned for some level of repair, and the cost per unit of each repair is 400. Now you have to be careful here. We have to figure out how many units do we sell. So total sales year 1 are estimated to be 150,000 divided by 3, because each bundle, remember, is 3,000. So you have 50 sales, and you expect 10% to repair it. 10% are to be repaired, which is, of course, 5. And the cost per repair is 400. So that is 5 times 400, which in this case is 2,000. So your expected warranty costs in the first year, which is the assurance warranty, is €400. So in this case, you are going to debit SOPL expense, credit warranty provision. It's going to be 2,000, 2,000. So that is under IAS 37. It is not under IFRS 15, because that's the first year where it's kind of a guaranteed warranty. It's not really adding any additional value add. So it's the assurance warranty. So you get the total number of units sold, then you get 10%, and then you multiply by 400 for the cost of each repair. So that's dealt with the assurance type warranty. For the sales then, the service warranty, that needs to be, you will recognize that revenue over the 2-year period. it relates to, which is year 2 and year 3. Because remember, the first year post-sale is the normal warranty. The 2-year extended warranty only kicks in after that. That's why you're paying extra for it. So it will be debit bank, in this case 150,000, because that's how much you sold this year. They were cash sales, so the money is the debit bank. You will credit revenue, the amount that's relevant to the product, which is we said 50 units in total, because we got the number of sales, times 2.5. Or if you wanted to say, that's the same as saying 150,000 in total, times 2.5 divided by the total 3. So you can get the portion. 2.5 divided by 3 is 5/6, or about 83.3%. So that can be recognized in year 1, because once you sell the product, you transfer the risk and reward of ownership, you can recognize the revenue. However, the remaining credit, you're going to credit deferred income or deferred revenue, and that is going to be a non-current liability. So it's going to be split between current liability and non-current, and that is going to be 25,000. Or it can also be calculated by saying it's 150 in total times 500 over 3,000. So what you're saying there is you only recognize the revenue from the extended warranty when that period kicks in. And that period does not kick in until next year and the year after. Right? So it's actually, even next year, you're probably still falling within the 1-year period. But it's certainly not going to be revenue. It's going to be credit deferred revenue. And you'll probably have to then do an estimate of, well, in what month of the year were the sales made, and when does the extended warranty kick in. So it does get a bit more complicated than just looking at everything as a single date of sale. You have to look at when the sales were made during the year as well. So you'll know when the 1-year and 2-year warranties kick in. But that's the key point here, is showing the debits and credits. The assurance warranty is done separately as IS37. The service warranty is treated as a performance obligation, and it's treated under IFRS 15. So make sure you keep an eye on that and look at the question pack as well. The other thing that's covered then in IFRS 15 is this thing called a consignment arrangement. Now this is quite common in the business world, where it's essentially a sell-through approach, where what happens is distributors will sell products on to retailers, but there will be a right to return. So what we're saying here is the retailer does not have to pay for the goods until they sell it on to the end consumer. So what essentially happens there is you have a distributor. They say, I'm going to sell we'll say they're, for example, carpets. So you're a manufacturer, distributor of carpets. They sell into a company like Des Kelly or Home Store and More. And they say, right, I'll sell you these carpets, but if you don't sell them on to your end consumer, I will take them back. Or you can bring them back and there'll be no price paid. So essentially this is what's known as a consignment arrangement, where all the risks and reward of ownership haven't transferred. Because the retailer, if they don't sell them on, they can give them back to the manufacturer or the distributor. So even though they have physical possession of the goods in their store, from an accounting perspective, they're still in the ownership of the manufacturer. So they're on consignment somewhere else. So you'll see that, you might come across it in auditing as well. It's an important one to watch for. So it's important to understand the agreement of when an entity delivers a product to another party. You have to figure out, has the other party obtained control? If they haven't obtained control, you cannot recognize revenue, nor can you de-recognize inventory. That's what we call the product is held on a consignment arrangement, and you shouldn't recognize revenue then. So it's an important one to watch for. What are the key indicators you're looking for? The product is controlled by the entity until an event occurs. So for example, until the retailer sells it on to the end consumer, the product can be recalled or it can be given back. Right? The entity is able to require the return of it to a third party, or the dealer does not have an unconditional obligation to pay. So for example, the retailer does not have to say, I don't have to pay for those carpets until I sell them on. So there's less risk on it from the retailer's perspective, because if they can't sell it on, they can give it back to who they got it off, and they don't have to pay anything. So they don't take on the risk. So that means you shouldn't recognize the sale. Right? So if the entity can require the customer or distributor to return the product, what we often call that as a call right, control is probably not transferred. And in that case, it would be wrong to recognize a revenue. What should be done is you leave it as inventory. And if you have received any money from the customer, for example, a down payment, that down payment will be recognized as a liability. Much the same as where Ryanair have unearned income, you can only recognize it when you earn it. So watch, if I'm giving more information about, well, why am I told that the customer has a right to return? And why am I told that they don't have to pay for anything until they sell it on? Red flags should be going in your head. This may be a consignment arrangement. So let's look at a small example to illustrate this. So a manufacturer provides household goods to a retailer. The manufacturer retains title until they are scanned at the register. And the retailer does not have an obligation to pay until a sale occurs and any unsold products may be returned. So this could be, for example, take basically one toilet roll. So toilet roll manufacturer, they can give it to SuperValu, but the toilet roll manufacturer retains the title until they're sold at the register. So what that means is the supermarket doesn't have to pay until they sell it on, and anything they don't sell on, they can return to the manufacturer and they don't have any obligation. So in reality here, you're also told the manufacturer has the right to call back or transfer any unsold product. So that means the manufacturer can go in, take their consignment of toilet roll and say, we want that for something else. So in reality here, the risks and reward of ownership are still with the manufacturer. They don't get money until it's sold. They have control if they want to take it back. And if the retailer doesn't want it, they have the right to send it back as well. So when does the manufacturer recognize revenue? The manufacturer here under IFRS 15 will only recognize revenue when it is sold on to the end consumer. This is what we call a consignment arrangement. So although the physical goods are in the retail shop, they are still on the accounts of the manufacturer because the risks and reward of ownership have not changed, have not transferred hands. They will only be de-recognized as revenue and de-recognized as inventory and recognized as revenue in the manufacturer's financial statements when the product is sold through. So that is what a consignment arrangement is. Just keep an eye out for that. We're looking there at the substance of the transaction. The substance here is the manufacturer owns and has all the risks of ownership right until it's sold on at the register to the end consumer. So that's just giving you two practical real world problems of what IFRS 15 has to cover. So it's quite a complex standard. There's a whole other section called IFRS 15 to deal with construction contracts. You don't need to worry about that until AF3. For now, we're just looking at the revenue from products and services. So IFRS 15 also has a lot of detail around the disclosure in terms of disaggregating revenue and providing a lot more detail about it. So there's a big change and step up from the old IAS 18. I'll give you one example in terms of disaggregation. You have to now split it across geographics, split it across the segments you look at, and also the major goods and service lines you give. So you have to give a lot more detail about where your revenue streams are from. And of course, that's to inform the users of financial statements. They want to know where are your revenue streams geographically, where are they in terms of what are you selling, where are you earning your money, so they can make more of an informed decision. So that was a big change compared to the old IAS 18, which had a lot less onerous disclosure requirements. And to give you one good example of that is CRH. So I've just taken the CRH annual report, which is available on Loop. And if we go and look at their annual accounts. So look at their annual accounts here. Their consolidated statement of income. They have 26.7 billion of revenue. So it's a huge multinational company, Smith Roadstone Holding. And if you go to note 1, they actually give you disclosure of the revenue. That 26.7 billion. If you come back up here to note 1 on revenue, they'll tell me here the 26.7 billion, it's split across Europe, different divisions, and Americas and Asia. And they give you more detail then, particularly what geographic extent. So these are the divisions that they look at, what we often call reporting segments. So they have Europe heavy side, Europe light side. That's just depending on the type of business. It could be quarries, it could be building materials, and then they give the geographics. Continuing operations means the ones that are going to continue next year. Discontinued operations are the ones that were sold off during the year. So don't worry, you'll cover that. It's actually standard in itself, IFRS 5. And as well as that disclosure and talking about each of their divisions. So Europe Heavy Side, for example, is involved in cement, lime, ready mix. Europe Light Side is involved in architectural products, shuttering, network access. So it's a bit more lighter material work. So that's how they disaggregate the revenue in this one. And they also split it another way, that they show you the different types of line items. So how much money they're selling in heating and plumbing, how much they're selling for cement and lime, how much they're selling for aggregates, which is the likes of your load of gravel or your load of stone that you might use for a driveway. So there's a lot of information there, but you're still getting back to the 26.7 billion and 26.7 billion. So it's all about slicing and dicing it, and that's all coming from IFRS 15, the disaggregation of revenue. And that's required under the standard. So it's a very good one to give you an idea of what's involved and to understand. That's where the reference to IFRS 15 comes in. So that's a nice one to have a look at. The other one that might be useful as well is just look at their accounting policy on page 133, which we covered in IS 8. They tell you revenue recognition, how they recognize revenue from the sale of goods, how they recognize revenue from construction contracts, which again is beyond the scope here, but it's all to do with IFRS 15. So it's no harm to have a read of it to see the stuff we're covering in the notes, the stuff you're doing in exam questions, that's readily applicable to real world companies. You can look at a narrative form in terms of talking about, see here, variable consideration. Talking about that, they're talking about whether it's a principal arrangement or an agent relationship. All of the stuff you cover in your lectures is readily applicable. It's just a matter of finding good real world examples to link it back in. So have a look at that, note page 133, and have a look at note 1 as well in terms of revenue, giving you some practical examples. Right. So chapter 4 in Connolly textbook is very useful, as is question pack 13. And we'll do a tutorial in IFRS 15 as well, giving you some exam standard questions. And this is a new standard, but it's a nice summary in the IS Plus website if you want to look at it and see where it's coming from. So IFRS 15 revenue from contracts with customers. All right. So that's looking at part 2 of IFRS 15. So it's one of the most important standards in modern accounting. It's only 2 or 3 years in effect. And it was a huge change to revenue recognition. And remember, revenue is one of the most important line items in a set of financial statements. So it's going to have huge implications when you go out either as an auditor or when you go out working in an accounting function of a company.